So the educational point I'm looking to convey today is that commodity prices are set by the marginal and not by the average cost of supply. It's a simple point really, but oil is the perfect commodity to illustrate this argument. So here goes. The world consumes just under 90 million barrels of oil per day. About a third of that, well actually it's a little bit more, about 40% of that is consumed in the old industrialized developed world. That's the United States and Europe. But that's kind of leveling off. Okay, it was falling in prior years, but it's kind of leveling off or growing slowly now. All the new demand growth for oil is coming out of China and these developing countries. China alone is responsible for about 10% of world consumption. Because remember, oil is principally used in transport fuels. That's in roads, transport for cars, trucks, and all that sort of thing. A little bit in power generation as well. Now, it makes sense, given that that's where all the new cars and trucks are coming on the market. So that's what you'd expect. Oil-producing nations consume a hell of a lot of oil as well, but that's because it's free. In other words, countries like Saudi Arabia using oil to do water desalination. But let's leave that little wrinkle aside. Net of all of this, oil demand is growing slowly worldwide. At the moment, on the other hand, supply side looks kind of okay, but it's getting a little dodgier. So you've got countries like the Saudis, which have got enormous oil reserves, and the Russians, of course. They seem to be meeting the current demand, but there are questions about their ability to replace existing supply with new finds. Each year, that's getting a little bit harder. Now you come along with a situation like we've got at the moment with this political unrest in Egypt, Libya, and Syria, and the likes. These are not significantly contributing nations to world oil supply. We're talking about a couple of 100,000 barrels a day here or there. One or two of them in aggregate starts to make a difference to the total picture. The reality, however, is that these autocratic regimes in these countries kept a lid on things and kept the oil flowing. In hindsight, Hosni Mubarak doesn't sound like a great guy to have as your leader, but you know what? He kept the taps open. That's why the Americans liked him. Ditto with Muammar Gaddafi. So in my opinion, it's going to be a mess in that region for the next 20 to 50 years. People say, oh, well, they're the good guys and the bad guys. I don't think so. There are a couple of good guys and mostly a whole lot of bad guys. With these revolutions, these countries are trying to drag themselves from 15th century politics to 18th century politics. Okay, you say. These guys are small suppliers of oil, so who cares? Why is it having such a big impact on the oil producing prices? The fact is that countries like Russia and Saudi are working to keep the market fully supplied, yes, and to date all the oil's refineries are running smoothly. So why are these prices keep going up, you ask? Well, here it is. It's because the market clearing price for a commodity is the marginal cost of the next and last barrel, the most costly final barrel that meets total demand. So if Syria goes down, who steps in to take their place, and what is their production cost? If the Saudi reserves are not what we think they are, and in years to come they're going to start having to bring more expensive oil online, well then that's going to be the price at which the global market clears. And these prices that are required to bring extra producers on in dodgy places like Nigeria and Venezuela, they have to come to the party. So it's unlikely that the Saudi Arabian king will get unseated, but it's a non-zero probability, right? So remember, marginal pricing is what sets the price. Capiche?